Hello everyone and welcome back to TradingView Snaps. My name is Tagatha and I'm here to take you through some of the highs and lows of what has been going on in the market so far this week. We're going to kick things off with the weekly heat map, which as you can see is fairly deep in the red, unfortunately. If we slide this down to a monthly, things are not looking much more positive, which is especially disappointing considering how high people's hopes were for an August in the green. It's nearly the end of August, so it's looking unlikely that that is going to actually happen. July was a pretty stellar month for the market and people hoped that those gains would continue on. But unfortunately, it looks like we've seen a little bit of a reversal the last couple of weeks. Risk assets got absolutely smacked in the face last week when Fed Chair Jerome Powell got up on stage at Jackson Hole and basically said that the fight must go on against inflation. This speech didn't actually give us that much more information than we hadn't heard before. However, he did use language that was quite a bit stronger than he previously had. A lot of people are considering it his most hawkish speech to date. The overall message was that the Fed is absolutely committed to getting inflation back down. The goal is around 2% inflation. He says that there's just not been enough economic data to suggest the dovish or to allow for the dovish pivot that people were hoping for, and that he implied could potentially happen in July's rate hike. Markets had actually been rallying the last couple of weeks, hoping that there may be good news in their future, but they turned sharply downwards on Friday after he got up on stage. It was actually a very short and sweet speech. He spent about 10 minutes talking to the crowd. It was the first time that everybody had met at Jackson Hole in real life since COVID, so since 2019, and the message was in rather stark contrast to the last message we heard this time last year, where he basically said that inflation was currently transitory and that we didn't have anything to worry about, which, as we all know, did not turn out to be the case. As I mentioned, nobody was particularly shocked. However, it did get people feeling a little bit anxious about what's to come in September. The bets are still sitting for a 75% basis point hike. There are a couple of people who think 50 basis points is on the cards. Truly, though, nobody is entirely sure, and it looks like we might just have to wait till September to find out. Speaking of people feeling anxious, that is exactly how everyone is feeling about the current energy crisis, which could be why people are taking another look at uranium. So this is actually a pretty interesting sort of re-emergence of a commodity story. Uranium, in case you didn't know, is widely used in nuclear energy, which is a clean form of energy, and is now sort of making its way back onto people's radars as everybody starts to panic about, well, not everybody, but a lot of the world starts to panic about how they are going to access oil and gas for the upcoming winter. The world actually turned on nuclear energy back in 2011 after Fukushima happened, and a bunch of countries basically shut down all their plants and all of their nuclear operations, and that has changed the last couple of weeks, which is what has got everybody talking. Japan, who was previously a huge consumer of nuclear energy until 2011 obviously, has now decided that it is looking at opening up nuclear plants once again, and Europe has jumped on that bandwagon and says that it's planning on rolling back its plans to shut down plants. So essentially it's going to keep its nuclear plants open. As he sort of seems to do with everything in the market these days, Elon Musk has gotten involved. He basically got up on Twitter and gave an interview saying that nuclear energy is not the future per se, but to not make use of nuclear energy would basically be a super bad idea for national security, the economy, and the environment. The global uranium ETF over here, as you can see, has been having a nice little jump. The last couple of days, it's up over 14% in the last sort of week and a half since last week, Monday. However, its non-green counterparts, oil and gas, have not been quite so lucky. As you can see, both have taken a little dip into the red in the last couple of days. Commodities are not the only ones struggling with inflation and what everybody thinks the Fed is going to do in September. Growth stocks have actually been super hard hit, which brings us to a little social media stock catch-up. Now that we're on the Musk vibe, we'll start there. Mr. Musk himself, has put in another termination request for his $44 billion buyout of Twitter. In case you missed it, a whistleblower came out last week and basically said that a former Twitter exec basically said that Twitter has absolutely no idea how many bots are on the platform, nor does it have the motivation to actually put in the work to find out. He also said there was a bunch of security vulnerabilities over at Twitter that nobody was addressing or even telling everyone else about. That obviously was music to Mr. Musk's ears. His whole bugbear, as it were, about his Twitter deal has been the amount of bots on the platform. Nobody can agree about how many there are, and that's sort of been the crux of the disagreement between both the parties. This whistleblower has been subpoenaed for the court dates coming up in the next couple of weeks. So it's likely we'll hear more from him, and that could very well play a role in the outcome of this trial. However, it is Elon Musk and it is Twitter, so there's likely to also to be a bunch more drama that happens before we actually get a final verdict. Twitter shares are trading at about $40 per share, quite a bit lower than the $54.20 Elon offered to buy it for. However, that's pretty much been the case since he made his buyout offer, and it's kind of looking like investors are holding their bets to see what's actually going to happen. In which case, Twitter shares are likely to go fairly mental. Then we're going to move on to Snap or Snapchat, depending how you remember it, if you're a millennial or not. But Snap has been really struggling the last couple of years, and they've now said, we'll say years, and they've now said that they are laying off 20% of their workforce, which accounts for about 1,000 people, pardon me. They're in the middle of a huge sort of turnaround plan for the platform. Most social media stocks have been struggling with declining digital ad spend. So Apple and its pesky privacy changes basically made digital advertising really, really tough, and that has been taking a massive toll on everyone's balance sheets. In response to that, Snapchat is going through this turnaround plan. They're hoping that laying off this 20% of staff will make room for finding alternate sources of revenue and upping its user base. That's the plan so far. We'll see how they do in the next couple of months. Then brings us to the last of the social media trifecta, Meta, the OG. Facebook has in fact decided to shut down its gaming app. So this app was only launched like 2 years ago, and it was all in the effort of competing with Amazon's Twitch service. In those 2 years, they have found that that is not so easy. The app has failed to do what it was set out to do, and they're now shutting it down. This is the latest in an ongoing slew of bad news we've heard from Meta. It's been a fairly long time since I personally have read anything positive about them in the headlines. Their stock is down about 53% so far for the year, so they are really struggling to get investors' attention. They have, in the last couple of weeks, announced a shift in strategy to focus more heavily on Reels, so perhaps that will be their chance at a comeback. But their Reality Labs division, which is the whole metaverse part of Meta, is really, really hemorrhaging money, as we saw in its latest earnings report. So here's hoping that shutting down its gaming division has any sort of impact on that. They are also not the only ones in the world of big tech giving up on their failed enterprises. Takes us to Amazon. Big old Amazon, who has this week decided to shut down its Amazon Care unit. So Amazon has been making a massive push into healthcare the last couple of years. There have been tons of acquisitions, service launches, acquisitions like this One Medical acquisition that CNBC is talking about here. Amazon Care was their telehealth segment of their healthcare attempts. And its sort of main competitors were Teladoc, which, now that Amazon has decided to shut down Amazon Care, has actually been pointed to by some analysts as a potential standout in the space. Healthcare in America is an industry that continues to evolve, and it's likely that these stocks are going to continue to make waves in the healthcare industry. Amazon, the rest of its healthcare endeavors are actually doing all right. However, healthcare is historically quite a hard industry to disrupt, so it'll be interesting to see if its other adventures have the same fate as Amazon Care. We've got a couple of other stories here that we wanted to touch base on for you. If you want any more details about them, we'll leave a couple of links in the description below. But we'll kick things off with Tesla, who has just completed its second ever stock split. They split their stock 3-to-1. The decision was made a couple of months ago when the stock was trading at like $900 a share. And the whole idea is to make the shares more accessible to a lower class of investor. So retail traders are actually a fairly important cohort for Tesla, and this is somewhat of a nod to them. Obviously, $900 per share is fairly out of a lot of people's financial reach, depending on your level of trading. And this is something that a lot of big companies have been doing. Amazon's done it, Google's done it this year, especially after the huge gains that many of them saw during the pandemic. The next piece of information we want to touch on on the retail trader vibe is Bed Bath & Beyond. So I'm not sure if you've seen recently, you actually have a look at the chart quickly, look at this extremely volatile few weeks of trading Bed Bath & Beyond has had. It's been to the moon and straight back down in just a couple of days, and that is likely to continue. As you can see, it is Wednesday morning and the stock has just opened down nearly 24%. That has come on the back of news that Bed Bath & Beyond has just found or just secured $500 million in financing. They have been feeling a ton of activist investor pressure recently to make the most of the attention that they're getting, essentially. Mr. Ryan Cohen, the GameStop chairman, has actually gotten involved and basically said that its CEO was doing a super bad job, and they have been trying to make a huge turnaround for the actual fundamentals of their business. This is the start of that. By the looks of today's share price, investors aren't feeling entirely confident. However, the volatility is likely to continue further than this morning, so make sure you're keeping an eye on that. Brings us nicely to Peloton, who actually has two pieces of news, or has had two pieces of news the last couple of days. The first got everyone very excited. Prices went up like 21% when they said that Amazon will now be selling Peloton's merch and equipment. So it's treadmills and famous bikes will now be sold on Amazon. Apparently there's like 500,000 searches on Amazon already every single month for Peloton equipment. So it does look like the hunger is there, and it could work out for the best for Peloton because their earnings came out the next day. Obviously, the stock then gave back promptly all of the gains from the previous day, but its balance sheet basically showed that it continues to struggle with both bricks and mortar sales and online sales. Obviously, online sales were booming during COVID, and then the pandemic kind of came to an end, and everybody was like, I don't really want a huge exercise bike in my living room when people come over for dinner. So its sales have really been struggling. However, this will hopefully get them access to a much wider audience and could potentially help restore their very, very struggling balance sheet. Lastly, we have HP, who gave us their earnings this week and basically reinforced the fact that PC sales globally are in the dumps, I guess. Global PC shipments declined by 13% from April to June, and HP's lack of PC sales have really driven that message home. They also cut their end-of-year guidance or their full-year guidance and reiterated a message that technology companies across the board have basically been giving us this earnings season. That is it from us today. However, do make sure that you're keeping up with economic news. You can take a look at TradingView's economic and earnings calendar. We have got earnings next week coming from EV brand NIO, as well as GameStop, which should be an interesting one. Other than that, likely to be a fairly calm week given it's Labor Day and a shortened trading week. Make sure, though, that you're keeping up with everything that goes on our Snaps page and also with our email, which is in your inbox every day by 9 a.m. Until then, stay safe out there and always remember to look first and then leap.